Wall Street might be ignoring them, but value investors are buzzing about these 5 stocks. They're so undervalued, you'll wonder how the market hasn't caught on yet. So let's dive in. Stock number 1, Uber. The name is synonymous with I'm too lazy to walk and where's my burrito? But jokes aside, Uber has built itself into a serious business and cash flowing powerhouse. So let's dive into the numbers because, as I always say, numbers tell the real story. First off, user growth is off the charts. 161 million monthly active platform users in September of 2024, which is a 13.4% jump year over year. That's more than adding the population of Mexico to their user base. Second, volume matters, and Uber's got it. In 2023, drivers completed 9.44 billion trips. That's up nearly 2 billion trips from 2022. Clearly, people are relying on Uber, making it more of a daily habit than a luxury. Third, this isn't just a ride-hailing company anymore. With Uber Eats, freight services, and even autonomous vehicle partnership, Uber's looking at multiple revenue streams. And it's a smart move. Diversifying lowers risk and opens up new doors. Now, that's all a great story, but how does it apply to investing into Uber? Analysts like Uber's long-term growth potential, but here's the key. It's moat. Uber's market position is hard to replicate. Competitors can't just show up and say, we'll do it better. Uber's scale and network are already too massive. They bragged early on that if somebody used Uber twice, they were hooked on it for life. And it seems to be about right. But of course, as value investors, we still need to ask the most important question. What is Uber's intrinsic value? Are they actually profitable, or is this just a shiny object? Remember, growth is great, but cash flow is king. And at the end of the day, you need to be able to see some sort of expectation of the cash coming in. We buy assets, we buy businesses, we don't just buy dreams. So let's look at Uber here. This is a $132 billion market cap versus $155 billion enterprise value. That difference there of $23 billion is essentially their debt. And guess what? Last year's free cash flow was $6 billion. Now look at it compared to the last 5 years, $570 million. That's 10x, 10 times more free cash flow. A few years ago, as the market shifted, the CEO said, listen, the market wants cash flow. We're going to concentrate on cash flow. And that has been wonderful for them. And you can tell right here in their profit margin from a negative 9.5% overall to 10.5%. And I love that their free cash flow is greater than their net income, both on 5-year and the 1-year level. So we got a lot of great numbers here, that 22 times free cash flow. Guys, I'm wondering if this could be like Netflix, where you sit there and go, okay, the numbers make sense-ish. It's a little bit of a premium, but there's a lot more cash to be generated from this business. Let's go take a look at these income statements. I mean, look at this revenue growth. It's great. It's absolutely, only 10 years ago, they did $3.8 billion in revenue. They now do that almost every single month. That's incredible. Now, what are the 8 pillars telling us? Well, the 8 pillars, as I thought, would be pretty ugly because you got 5-year numbers in here that are absolute garbage. The only check marks here, guys, 8 pillars, this is an example of where it's useless. In fact, I would look at this, not necessarily useless, but say, look how amazing things are. The only thing that bothers me is shares outstanding being up. That's the only one I'm really paying attention to here. Okay, but now they're generating cash flow. They should be limiting how many shares they're actually putting out there to market. Let's see what the analysts think about their EPS growth potential. $1.80 to $5.50. That's almost 3x, guys. Actually, is 3x. That is awesome over the next 3 years. And their revenue growth, 18, 16, 16, 8.5, 13. Big time revenue growth for a company that's still being used a ton in this world. Now remember, we are principle-driven investors. What that means is we have 4 major things foundations want to believe in. 1, we're investors, not speculators. What that means is we don't look at an investment, at an asset, and say we want to buy it hoping somebody else pays us more in the future. We're okay owning it for a long period of time. 2, every investment is the present value of all its future cash flow. 3rd, we don't buy it if we don't understand it. I think Uber is a very understandable business. It's not some convoluted, crazy tech company or crypto or anything like that. It's very simple. And 4th, we don't rely on short-term market price movements to tell us if we're right or wrong. We're going to look at this and say, if we're buying a company and the stock goes down and the fundamentals are the same and getting better, we buy more of it. Now, we put this all together. We have the story, which is amazing. We have the numbers, which are amazing. How do we put them together? Because remember, a good investor is not someone who just buys a good story, because they realize if they overpay for a good story, they're not investing. They're decreasing wealth, and we want to change that. So the stock analyzer tool here allows us to merge the story with the numbers together to figure out a price that makes sense to us. So let me pull up the last time I did Uber. Now, this is a 10-year analysis on Uber, okay? And I do 10 years on all my stock analyzers, basically. I did 6, 10, and 14% revenue growth, okay? I did 10, 15, and 20% profit margin, and the same for free cash flow. Guys, this could be low. This 15 number could be low because on free cash flow, they already did 14% last year. Now, what's a PE for 10 years from now? Much bigger company, probably a bigger moat. This is a company that's probably going to be worth some good money down the road and deserves a premium for it. I put 15, 18, and 21. I could understand completely if you said, Paul, you're being too conservative here. That's what makes the stock analyzer tool so great. That's why it's used over 1 million times per year by the investors in our community. The reason being is it allows them to put their own numbers in. And finally, I put a 9% return. Guys, this is not the return you should be buying stocks at. You can get 9 or 10% from a long-term ETF. So if you buy an individual company, you need a margin of safety because the future is unknown and we're humans and we make mistakes. So you got to put a number higher than 9%, but I put in 9 or 10% to give me like the intrinsic value for the business. So hit the analyze button, boom. Guys, I got a low price of 37, high price of 170, middle price of 85. And what's interesting here, guys, is pretty good return on our money here if things are right in the middle. The only concern I have is dilution. So you got to factor in a little bit more margin of safety, I think, in to see if you're going to stop their dilution by issuing more shares. Stock number 2, Intel. Probably the one that's going to get the most comments in this video. Guys, I'm an owner of Intel and it has been brutal. The CEO just left on his own accord, aka he was fired. Things have been tough at this company. Guys, I want everybody to remember this. This was the darling of 2000. This is the company where if you didn't have it in your portfolio, you were stupid. How many companies can you say about that today? Things change. Interestingly enough, the company, even with how poorly it's doing, has way more revenue today than it did back in 2000. And the stock has yet to hit its 2000 peak. This is a company that everyone wrote off during its rough patch. But if you're paying attention, there may be something big brewing here. And it's the kind of comeback story that value investors dream about. So let's dive in. After years of watching Taiwan Semiconductor and Samsung dominate the semiconductor foundry business, Intel decided to get serious. Their Intel Foundry services aren't just talk. They're already locked in major customers like ARM for mobile chips. So what does that mean? Intel is no longer playing catch up. They're gunning for leadership. You've got to admire a company that invests for tomorrow, and Intel is dropping billions, tens of billions in Ohio, Arizona, and Germany to build these factories that can do a lot of these things. And here's the kicker. Intel is trading at dirt cheap valuation multiples while showing the signs of a turnaround. Now, could it just be a falling knife? Yeah, it very well could be. This is what makes investing so difficult. We don't know the future. Now, remember, every investment's a present value of all future cash flow. We don't know what that future cash flow is. But based on Intel's rep and the fact they're still making a lot of chips, this could be a company that could still turn things around greatly. Is the juice worth the squeeze? Even if the chance of success is 20%, but the payout is 20-1, that makes it worth it. I'm not saying those are the numbers, but that's the way I want you to think. Because if you had 100 of those, you would make a lot of money. So let's take a look at Intel here. An $85 billion market cap business. Cash flow, terrible. Net income, terrible. Everything here is terrible. 35% gross margin used to be 45%. Guys, everything here screams terrible. But one thing I'll tell you is price to sales ratio, 1.6. This is pretty freaking low for a company, even with low gross margin like that at 35%. As a comparison, and I'm not trying to say that NVIDIA and Intel are the same company, but the price to sales ratio on NVIDIA, 30, 20 times higher. What about AMD? Price to sales ratio, 8.35, 5 times greater. Taiwan Semiconductor, 13 times sales. So again, when companies are having a hard time making cash flow and you can't value it off that cash flow today, one way to make an analysis of it is to look at their price to sales ratio, which I just did there. So guys, let's look at analyst estimates. This will be something interesting to look at. This is what's interesting to me. If analysts are right and they're back to 463 per share in profit here in the next 4 or 5 years, even times 18, you're looking at an $80 stock price right there. Again, could the juice be worth the squeeze here? Are they right? They're analysts. I don't know if they're right. It's hard to figure that out. Guys, the revenue, 53 billion, 56 billion, 61, 75, 89. So even analysts think that Intel is going to get back to amazing revenue growth. I don't know. It is tough, and they've been wrong so far. I have been wrong so far in Intel based on where the stock price is going. But it's pretty interesting to look at this. So let's pull up our stock analyzer tool, and let's take a look and see what this thing could be worth here in the future. Guys, I did a very paltry 0, 2, and 4% revenue growth from here. I did profit margin of 14, 18, and 22. Same with free cash flow. Guys, look at my PEs here. I did 12, 15, and 18, and a 9% return. I beat this thing up. Hit the analyze button. A low price of $19.58, which is pennies below current price. High price of 51, middle price of 32. Could the juice be worth the squeeze here? Maybe so. And this is a company that was at $48 a share just recently in the last year, year and a half. That doesn't mean anything to me in terms of saying it's worth it, but I look at this saying, I made a lot of pretty conservative assumptions. Yes, the story is really bad, but the story has to be pretty bad. The question is, do you think Intel is going away? Listen, people were already trying to look at buying them this year. That's what's interesting to me. Stock number 3, Dollar General, and their story is fascinating. It's a blend of strategy, resilience, and growth. So imagine this. 75% of the US population lives within 5 miles of a Dollar General store. That isn't just convenience, guys. That's absolute dominance. They've mastered the art of being right there for millions of Americans, especially in areas where big box stores can't or will not go. They are catering to low to middle income consumers, a group feeling the pinch from inflation and stagnant wages. When money's tight, where do people go for essentials? Remember, I showed you guys last year, Lowe's, Home Depot, Target all saw major same-store sales decline, while companies like Walmart saw major increases. These same consumers are turning to Dollar General for affordable groceries, household goods, and even more. This demographic is growing, making Dollar General a consistent go-to in both good and bad economic times. And here's the kicker. Dollar General is considered recession-proof. During downturns, it doesn't just survive, it thrives. When belts tighten, customers will have to flock to the budget-friendly options, giving Dollar General a solid hedge against economic uncertainty. And they're not resting on their laurels. Over 1,000 new stores are being added in one single year. Add in initiatives like fresh produce and telehealth services, and you can see a company that's adapting to evolving customer needs. So again, we look at this chart here. All-time high back in 2022, April of 22 of $262. It's currently at $75. That's a drop of what? 65, 70%. Dividend, 3.2%. That's going to get the attention of a lot of people out there. And the best part is their dividend only eats up $500 million of their $1.5 billion in free cash flow. That's about 33% of their cash flow. That's pretty good, guys. So it's probably likely that these dividends are here to stay for a while. And who likes 10 times free cash flow? Who likes almost single-digit PE? That's what they have here, guys. They have almost single-digit price of free cash flow and PE. Way better than 30 or 40 times what it was before back in 2022. So let's go check out the 8 pillars here and see what this looks like. All right. A lot of debt here. Probably the leases on those places doesn't worry me so much. Net income and cash flow did not grow along with their revenue. That's something to take a look at. Why is revenue up $13 billion, but free cash flow and net income are down? Not the highest return on invested capital. This means that they don't get, some astronomical return on the money that they put in the business. So I think this tells me, okay, listen, they dominate this market, but this low return on invested capital, maybe do a little discount to your earnings multiple for that reason. But let's see what analysts are saying about the company. Okay. 770 to 1216 over the next 5 years or so in earnings per share. So 50%, no more than that, 60% earnings per share growth. And revenue growth, 5%, 5%, 5%, 9%, 6.5%. So middle single digits. Again, nothing to write home about, but it's inflation plus adding some stores along the way. So the question is, what's the price to pay based on Stock Analyzer tool? Here are my assumptions. 3, 5, 7% revenue growth. 5.5, 6.25, 7% profit margin. 4.25, 4.75, 5.25 on free cash flow, which is actually looking a little high compared to their last 10 years. Now, PE and price of free cash flow, you heard me talk about a little discount to it. I did 13 to 17 with 15 in the middle. And my 9% return, the stock is currently at $74 per share. Hit the analyze button. Wowza, guys. 110 to 140, 215 to 285, and 150 to 200 in the middle. Now, these returns here include dividends, but geez, OP, this could be well worth a look. I mean, these are really high returns. And yeah, I was a little aggressive on the free cash flow margin, but you look at those PEs, I wasn't pretty aggressive on the PE and price of free cash flow. So it's something to look at. Now, guys, investors in our community have analyzed over 4,600 stocks this year alone, and Dollar General happens to be one of the stocks that our community has been discussing and analyzing a ton this year, and it's pretty obvious why. If Dollar General is on your radar, you should go have a conversation about it inside the Everything Money community. Go in here. First off, do a search for where it was being done. You can search the exact stock. It'll take you right to that conversation. So you can follow up and say, guys, what are you thinking? And you can take a look at what people said before you even comment. Now, if you're new to our YouTube channel and you visited our site, you may have noticed that we have a waiting list at everythingmoney.com. And the reason for that is this software today includes all of these tools we have here. Guys, before I even started recording today, I'd use this tool and this tool before I even came to the office for my own personal use. I made this software so I could make better investing decisions. But behind the scenes, we are making changes. So in a short period of time, this offer of everything is going away. Now, I use the software because I built it for myself. And it was created because people kept saying, how do I get that software when it wasn't available to everybody? So we made it available to everybody. And I make better decisions because of it. Not just the stocks every single day that have helped me buy 26 companies over the last few years, but Real Estate Calculator has helped me buy over $30 million in real estate this year alone in 2024. And for 2025, our goal is to buy $50 to $60 million, and that'll be the tool we use to do it. But as we grow, it's less about me and more about how you can better serve you in the community. And this is exactly why we have many developers working on this software every single day to give you the updates that you guys need. Now, the good news is these changes haven't been made yet. So if you join today, you'll be grandfathered in for life with everything. And this is the best deal we've ever offered. So go sign up. As long as you join the community before we make the changes, you keep the plan, and even better, you stay in your pricing tier forever. So click on the link in the description below to get access to everything we have to offer, including all these investing tools in the community. And I assure you, it'll be the best investing decision you closed out the year with. Stock number 4, ASML Holdings. This is another company that investors inside our community discuss very frequently. It's the company most people don't know, but unknowingly rely on every single day. So let me break this down, why this Dutch powerhouse is a name that the people in our community and the investing world are watching very closely, and why it's so important to the global economy. So first off, ASML's claim to fame is its monopoly on extreme ultraviolet lithography machines. When I say monopoly, though, I'm not exaggerating. Nobody else in the world can make these machines, and they're essential for producing cutting-edge semiconductor chips. Without ASML, there's no AI revolution, there's no iPhones, there's no electric cars, there's so many things that we take for granted now. With its iron grip on EUV technology, ASML sits at the heart of a $600 billion semiconductor industry, poised to grow even more with AI and 5G. But dominance like that has its challenges. US restrictions prevent ASML from selling its EUV machines to China, throwing the company into the middle of a geopolitical chess match. Now, for investors, their strategic importance is hard to ignore. Its machines are the gatekeepers of tech innovation. But at its current valuation, the question is simple. does the price make sense? Remember, every investment boils down to one thing. You're buying future cash flows. The question is, can you buy it at a discount that makes sense? If ASML fits that bill, it's worth a deeper look. If not, there's no shame in waiting for the right opportunity. You've seen countless times how many companies that people will say, there's no way that stock is falling, will plummet 60, 70, 80%. Patience is the investor's best friend. So let's take a look at this company right now. Currently at $7.10 per share, all-time high of $11.10 just back in July, and now at $7.10. Guys, that's a huge drop for a company this big. Great balance sheet, $281 billion market cap versus $300 billion enterprise value. Now, I will say one thing I don't like. Free cash flow, $3 billion last year, 5.6 in the last 5 years. It's a little bit behind the 5-year average of 6, but net income of $7.2 billion. So it took a big hit to free cash flow. Focus on this 5-year free cash flow number. Now, 50 times 5-year free cash flow and 46 times earnings is pretty expensive. And the other thing is, I want to go check out, how do they do in the last 5 years as everything surged? 11.4 billion, 12.3, 14.5, 19.4, 22, 28.7. They finally saw a dip in the last 12 months on their revenue compared to previous years. But look at the surge. I mean, it just kept growing and growing and growing. What I like about it is it's still growing, even though the semiconductor chip market was really skyrocketing and started to fall a little bit in recent years. Okay, so this could still be good. But again, 50 times free cash flow. Okay, let's check out the 8 pillars here. Guys, what do we love seeing here? Just a stock, according to the pillars, we just need to be a little patient on, waiting for the price to fall. But everything else looks pretty good. One thing I don't like, what we talked about earlier, the last 5 years has seen a $3.7 billion increase in net income, while only a $600 million increase in free cash flow. So it's something to pay attention to and make sure it's not a trend that's going to continue on here. So what are analysts saying here? Wow. $20 EPS going to 51 bucks, 2.5x in the next 4 years. Maybe that's why it's selling for 50 times free cash flow. That's a lot of growth there, guys. That's a lot of growth. And that deserves a premium if it comes true. In terms of revenue growth, double digit. 16.5, 14, 25, 14. Big time growth here. So this is a company that's selling for a really high premium, but might be worth it based on its growth potential. So let's check out the stock analyzer tool on this company, because it's really, really important for us to focus on what that present value of future cash flows could be worth. Now, I did 10-year analysis. I did 8, 12, and 16% revenue growth. Profit margin, 22, 24, and 26. I did the same thing for free cash flow. If you see here, apart from this last year, they had pretty good profit and free cash flow. The last 5 years, a lot closer together. So I like that. Now for PE, 15, 18, 21. I don't know if that's right. I don't know if you think it's right. Whatever you want to put in there, please do. But definitely do not put 9% desired return. You need to have that margin of safety with a much higher desired return. I have a low price of $340, high price of $930, middle price of $560. So this tells me, from my perspective, I just need to be a little patient. I need to wait a little bit longer, wait for the stock to fall further, or fundamentals get a lot better. Stock number 5, another company I own. And guys, don't ever own a company just because somebody on the internet does. We're here to teach our principle-driven investing process. It's here to teach a process. I own 24 companies and 2 ETFs. I will explain them till I'm blue in the face, and I'm not going to be right on anywhere close to all of them. It's about teaching that process. Now, with that said, I do think Alibaba has one of the biggest potential gains out of all the companies we've talked about. It is called the Amazon of China. And that label is pretty accurate to a certain point. Now, they're called the Amazon of China. And I think that label is getting even more accurate as time goes on. Like Amazon, they dominate e-commerce with Taobao and Tmall platforms, driving massive user engagement. And they're not just selling stuff. They're creating ecosystems. And their VIP membership program now has 46 million loyal, high-spending users. That's a powerful moat. It locks in customers and keeps competitors at bay. And then, just like Amazon, There's Alibaba Cloud, which is a juggernaut in Asia, and it ranks among the top 4 global cloud providers. But here's the rub. Despite having a business model firing on so many cylinders, Alibaba has seen its stock crumble from $300 down to a current price of $84 per share. That's an eye-watering drop, especially when you compare it to Amazon, which has doubled over the same time frame and trades at nearly 50 times earnings. Meanwhile, Alibaba sits at a modest, low double-digit multiple. So why is that? Well, this isn't about Alibaba being a bad company. It's about sentiment and geopolitics. The market sees China as a wild card, and that uncertainty slashes Alibaba's valuation multiple significantly, even though it arguably has more growth runway, with China's middle class expanding faster than America's and Amazon's core US market. Add to that the $1.4 trillion stimulus package, which will definitely directly benefit Alibaba as local governments reinvest, paying off debts and empowering the middle class to consume more. And don't forget, they are buying back shares like crazy. In the last quarter alone, they spent $4.1 billion buying back their shares and reducing share count by 2.1%. It shows that management believes in their company and thinks their stock is undervalued and willing to act on it, putting the money of the company where their mouth is. This is a classic lesson. Investing is about buying things well, not just buying good things. Alibaba isn't popular right now, but popularity doesn't drive returns in the long run. Value does. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. And at $84, Alibaba might just be a gift-wrapped opportunity for disciplined investors willing to ignore the noise. In fact, a lot of great value investors have gotten on board on Alibaba under $100 per share. So let's check this out. $203 billion market cap, $12 billion in free cash from last year, $19 billion over the last 5 years. Significantly different than their 5-year average net income of $13.5 billion. No dividend, which I love. They're buying back shares. Guys, companies that buy back shares just keep increasing the value for their investors if they buy back the stock cheap. That's what I love. And this company is currently selling for 11 times its 5-year average free cash flow. 11 times. Every single thing I hear about Alibaba stock, about why it's bad, was the same thing. It all existed right here. But yet what happens? News follows the stock price. As the stock started to fall, all those issues that were happening started to come up. That's very consistent across history. So let's check out analyst estimates here. Funny thing is, analysts might be buying in the same thing, $8.72 to $9 per share. That's pretty bad. Not much growth in the next 5 or 6 years. But again, at 11 times free cash flow, if they keep this the same and keep buying back their shares, and they keep buying back 2 to 3% per year, in the next 5 or 6 years, they bought back 10 to 20% of the company, increasing value and increasing that earnings per share for its investors. But the interesting thing to me is how revenue is going from 130 to 180 billion, and yet earnings per share is staying flat. Are all of a sudden their margins going to get a lot lower? I don't know. It doesn't add up to me. Very well could be the case, but it doesn't add up to me. So let me show you guys what does add up to me. Let's go to our stock analyzer tool and let's pull up my last assumptions for the next 10 years. Guys, 3, 6, and 9% revenue growth. Nothing insane. Profit margin, I did 12, 15, and 18%. And for free cash flow, I did 15, 18, and 21. Might be a little high based on, but if you look at the 10-year numbers, both of these 10-year numbers are higher than my middle assumptions here. So I'm going to assume they get back to really good growth. Don't forget, China's fast-growing middle class. Yes, they have a decline in population, but the average person in China makes $12,000 or $14,000 a year. The average person in the US makes over $70,000 a year. They have a lot more growth potential for their middle class. That's what's impressive here. And of course, I did my 16, 18, and 20 times earnings and 9% desired return. Obviously, if you don't feel comfortable with China, do not look at the stock any further. But we hit the analyze button. The stock's currently at 84. We have a low price of 105 to 130, high price of 285 to 330, middle price of 175 to 210. Guys, check out the community, $7 for 7 days. Go try it out. Thank you very much for your time.